Welcome to Dental Unscripted, where Mike Dinzio and Paula Quinn break down the practice ownership journey, one episode at a time. Starting up, buying, and running a successful dental practice.
All right, guys. Welcome back to another episode of Dental Unscripted. As you guys know, I'm Michael Dinzio. My co-host Paula Quinn are both on the program today, and we are excited about getting into this really interesting topic of all things DSO. So DSO Playbook Partnership. We want to really break down this idea of how DSOs are purchasing practices and what you might be up against as a private practice looking to buy a practice. And also feather in for those folks that own a practice and is thinking about your exit, what it looks like to potentially sell to a DSO. And I'm really excited about today because we have two amazing dental attorneys in the industry. These two are titans in their own respect as far as how many dental transitions these guys touch on a yearly basis. I've known them both for a really long time. If you add up the stats between the three firms represented today, we have a lot of knowledge and experience. So without further ado, I'll start with the West Coast because it is the best coast. Ali Oromchian with DM Counsel. And we've had Ali on the program a bunch of times. We broke down LOIs. We broke down all kinds of fun things. He also has a fantastic podcast you need to check out. And then on the East Coast is no one better than David Cohen, Cohen Law. David, I know you touch a ton of DSO. You both do, and there's no one else that I would have asked on the East Coast to represent. We know, being on the West Coast, that things can be a little different on coast to coast, and so you are here to represent that East Side. And so thank you both so much for being on and just giving your time. And I know, Ali, you have a podcast. And it's awesome because you give back to the community. It's a lot of time and energy. And I think the people, the listeners, appreciate it. Paula, also, you bought from a DSO. So I'm be interested to hear your perspective as you saw some challenges in buying from a DSO, which is the opposite of what today's topic is. So thank you all guys for being on the program. I really appreciate it.
Thanks, Mike. Yeah, no, I appreciate you inviting me to be on. And you know, even though I am on the West Coast, I feel like I really, my genes are East Coast based because I was a big Notorious B.I.G. fan. And I feel like I'm the only person in the West Coast who's, a fan of his as opposed to Tupac. But, it is what it is.
Tupac all the way.
It's
Tupac.
It's funny. Michael said East Coast and West Coast, I wanted to do some kind of sign, but I'm like, I don't even know what it is. And what if I do something back? I don't know.
That's right.
That's right. Yeah, no, it's excited to be on, and yeah, it'll be super fun. So thank you.
David, thanks again.
Yeah, likewise. Really excited to be here. Always appreciative. I know this is a huge podcast, and I'm just thankful to be here and looking forward to chatting with you guys and Ali and hearing what Ali has to say as well. Just, obviously we see deals, but you see similar and different deals, and always looking to see different perspectives. So everything for me is a learning experience, and I'm looking forward to hanging out today.
Yeah, I love that, guys. I think we can all speak to this every single day. We learn new stuff. We touch a lot of deals, but it's funny how every once in a while there's a curveball. It's like, how should we approach this, right? So, which is pretty cool about our industry. So enough of the fluff. I know that you all are probably driving to work right now, and so let's get into this topic, all DSOs. So first and foremost, I think the best way to tee up this episode is really, and I'll start with the East Coast. David, let's start with you, buddy. How would you describe today's DSO market? Like, in my mind, David, it was hot. It was fast and furious. It was growing like crazy pre-COVID. And things got a little weird after COVID. And then has it rebounded or not? And are you seeing the same volume? Give us just kind of a market awareness of how the DSOs are approaching this dental industry real quick.
Yeah, I think, you nailed it, that DSO transactions from my firm's perspective, and also a lot of the colleagues that we work with, were significant, particularly like right after COVID and during COVID even. After that happened, from my perspective, there was a bit of a correction. I think that has changed a bit since this year. This year, I've seen the deals pick up. And my industry colleagues have also seen the deals pick up as well. They're not picked up, from my perspective, to the same extent that they were when things were going crazy and money was cheap, during COVID. But we're definitely seeing more DSOs either, kind of dipping their toes back in and testing the waters after the correction occurred, and also others that are, just deciding to start up and go strong from the beginning. They have the financing, and others that were strong the whole time. There certainly were DSOs that were strong for the entire period that haven't really changed or wavered or anything like that. But I think it's definitely an uptick, I would say. And I think there's there's some apprehension, I think, among these DSOs, and there's a bunch of apprehension, I think, from sellers as well. Sellers have seen a lot of success stories from their colleagues, and they've seen a lot of horror stories from their colleagues, depending on the DSO, depending on the situation, depending on, all the factors that were, taken into account. So I think everybody's sort of like feeling each other out a bit, but definitely more willing to step to the table than they were, a couple of years ago.
Interesting. Ollie, are you seeing the same thing on the West Coast or slightly different? What's your perspective on the market?
No, I totally disagree with everything David said. No. I mean, that's exactly right. I think that's exactly what's happened and is happening right now. But the key, I think, is this: the FOMO that people had to sell to DSOs is long gone, right? It's long gone. And the reason is because that heyday of money was cheap, and these groups and private equity backed DSOs were buying left and right, is not happening anymore, right? Because money is not cheap anymore. The money for the private equity folks has dried up to a large degree. And the reason is because that whole idea of let's just buy EBITDA and just build and then sell was flawed from the very beginning, and now we are seeing the impact of that. I mean, we've had 7 separate DSOs, 7 just this year, go on earnings calls with their partners and say your shares have zero value.
Oh my gosh. Well, I actually want to get in. I'm glad you actually said that, Ali, because I remember going into COVID, and I was actually representing a seller in that moment. And going into that negotiation, a lot of big numbers were being thrown around, and then the world collapsed and they changed their offer. My client was like, what just happened? And I'm like, dude, the market is literally shifting on you right now. And it's interesting in that, I didn't understand it either. How DSOs could buy these, frankly speaking, small profit margin practices when you are paying the dentist. When you pay the dentist, you don't have that much left. Paula owned a practice and had to pay for a dentist. She in a lot of ways, she ran the DSO model when she owned. There's not a ton of profit there. And if you have to debt service, you guys both talked about that. You both did. If you have to debt service, now your profit's gone, or there's even less. Yeah. And so I'm sitting here thinking, how are these DSOs surviving with the hygienists that have gone up $10 an hour? Dental assistants have made up $5 an hour from pre-COVID to now. And I'm just like, how does this even make sense? So that I'm glad we're all on the same page. The market has softened. DSOs are not winning as aggressively, but they're still happening. Can we all agree that they're absolutely still happening?
Well, yeah. I mean, they are, and as David said, the good ones are still out there, right?
Mm-hmm.
But there's only a small handful of really, really good ones. And the problem, I think, is for a lot of sellers is that they go into these discussions being enamored by the first LOI, and David and I have been on both sides of that. It's like here's a number, suddenly it's like a 7-digit number that people are like, holy cow, I never thought my practice was worth this much, right? I'm going to go retire, in Fort Lauderdale where David is or wherever, and it's like no. Like, that's not reality. Just because they put that number there doesn't mean that, one, that is the number you get, but two, that is a sound financial decision, right?
Okay. So I mean, okay, so let's kind of pivot then. You said the solid DSOs. You both said solid DSOs. And I'm thinking to myself, like, okay, when I represented that one client that I had, it was like there was a lot of DSOs that were interested, but there were only like 2 or 3 that I knew and had relationship with that were reputable and are probably going to stand the test of time. So I don't know how many there are of those ones, but what does it look like? The next topic, what does it look like to be a good DSO, quote unquote? Like, if you were to partner with a DSO, and it is a partnership, because, and we'll get into the deal structure here next. But what does a good partnership look like from a practice owner's perspective when you sell, which basically means you're partnering with that DSO? David, why don't you take that one?
Yeah, I think that, it's not necessarily as much as good and bad with respect to DSOs. I mean, there's certainly some DSOs that have done wrong by their people that they have bought from. But for the most part, I think it's more about sort of a risk profile. There are DSOs that have been at it for a longer period of time than others. There's DSOs that have a track record, that have recapitalized, have owners that have recapitalized with other businesses even before this business, have a lot of they're continuing to show their strength by buying practices. They are pretty measured, and they're not always providing the highest valuations from what we see because they don't have to. And a lot of these DSOs are very client friendly, or I say client, doctor friendly, because doctors want to partner, as to answer your question, doctors want to partner with the DSO that's going to treat them like a true partner. And that's going to create a culture that is appealing, that lets them run things essentially how they ran them before, but also creates an environment that's fun, energetic, inspiring, and can be sort of collaborative even with other practices that are in the network, all with the same goal to recapitalize. And I think those are the great partners that you're seeing that didn't really waver during COVID. But they also, there's lesser risk, but there's also a lesser reward, right? A lot of these doctors get enamored by offers that are significantly more than maybe those tried and true DSOs would offer. And I'm generalizing here, of course, the tried and true DSOs, I'm sure for certain practices offer, high valuations, but I'm just saying in general, the more track record, the less risk that that DSO has to take. And that's less upside for the doctor that's going to sell to them. The newer DSOs that have to be competitive and have to, in order to grab the attention of doctors, have to offer better valuations or better allocations of the money in the enterprise value for the doctor to make it more appealing than those other maybe tried and true DSOs. Those are the ones that there's a higher risk, but there's also a higher reward for the doctor. And so I don't think it's as much good and bad as it is the doctor has to look at their own risk profile and say, what is the best fit for them? What's most important to them? Is it the most money they can get up front so they can mitigate any risk in the deal? Is it that they're pretty financially stable and they want to roll the dice and it really kind of depends on the risk profile that the doctor has. And I think that, combined with really the doctor trying to understand the culture of each of these DSOs, is really important, because when you talk about great partnerships, I think a lot of them fail. And this isn't just with DSOs. I mean, this is doctor-doctor partnerships too. But I think a lot of the partnerships fail because of a lack of communication and understanding of expectations, and with respect to personality differences and things like that. And I think it's really important for these doctors to vet out the DSO. And we're seeing a lot of doctors that are going sort of the opposite direction of brokers, because they don't want to pay a brokerage fee. And that's understandable. Brokerage fees are significant, but brokers have a value, and part of that value is vetting out the proper DSOs for the doctor that are a good fit, and creating a competition, but also creating a network of DSOs that are a good fit for that doctor, and really helping with that facilitation, as opposed to the doctor going straight to this DSO or that one because they can, and they can avoid a brokerage fee. So I think it's getting, sometimes a broker is great to have, sometimes not. I mean, I'm a proponent of having a broker involved because I think the good ones can really help the client, but ultimately, the culture matters, and the right fit matters. And to go back to your initial question, a partnership fails because it's not the right fit most of the time. Certainly there could be a DSO that just completely just overbuys practices. They're getting crushed. Everybody's stock is zero. It's a disaster. Of course, that's out there. But in general, I think the failures are because of the lack of a good fit. And we have a lot of doctors that it's not a good fit for them to sell to a DSO, period. It's great for some, and it's not great for others. And that in general has to be a fit for the doctor. Well, so long answer, but I wanted to kind of.
No, it's a great answer. I think it's a deep answer, and I love the answer. If this is a topic for you, I think you need to go back and listen to that part after the question that I'm about to ask Ali. Ali, you do a really good job of breaking things down bite-sized pieces. So David talked about a lot of little things of what makes a good partnership. Can you just give us, in your own words, what the normal deal points would be and how you would evaluate what a good partnership is?
Yeah.
Because I think this audience is going to be a younger audience. I think you're either just getting into ownership. Maybe ownership isn't a good fit for you. You hate it. You got into something, you don't want it. There's that out there. And you're looking for a partner to help. And you're thinking, oh, maybe DSO's the way. But like, what are the deal points, right? Like, break it down in a little simpler way. And then maybe folks listen to David's answer, rewind back after all these sections. Because I think breaking it down is going to help the audience.
No, I'd be happy to. So I would probably say, there's 6, not necessarily deal points, but 6 factors that as a seller you should keep in mind. Okay. So first is, and they all say they don't do this, but you've got to look in between the lines, which is, does the DSO interfere with clinical judgment? Okay. And what does that mean? They all say they don't, of course, because the regulatory people would lose their mind if they said yes. But you got to see, do they have production quotas? Do they have recommended minimum treatments? Do they pressure to crown everything and push perio treatment without, any insurance or whatnot? So I think that's the first thing, right? Do they discipline, remove like doctors if they don't hit their numbers? So that's number one. Number two, and this is way more important, and the thing that I see fewer sellers do, which is financial opacity, right? Like, do they have complicated compensation formulas or constantly changing compensation formulas? Do they have these crazy management fees that are excessive and unclear, right? Have they ever had like temporary cuts, in terms of pay cuts, right? So those things I think are real. And the part that I think very few people do is, does your partnership valuation, does it match the true EBITDA of their business and your business? And this is not something that any dentist can do. You need a financially strong CPA advisor to help you there, right? So that's 2.
EBITDA means profit, folks.
Yeah.
EBITDA.
Yeah. Number 3 is poor operational support, right? Do they have billing errors? Do they have slow collections? A lot of IT failures? Staff turnover? Like, I would look at that. Number 4, I would say, is their psychology. Like, are they short-term profit first thinking? Or, because if they're private equity backed, they might be thinking about really rapid returns, which means cutting assistants, front desk staff, hygiene time. That's going to make a difference, right? Pushing high volume, low quality dentistry, right? Like, just to boost revenue. I think that's number 4.
Mm-hmm.
Number 5, high provider turnover. Okay. So are associates leaving within a year, right? Are they always posting jobs for the same locations, right?
Mm-hmm.
Are employees burned out? Are they dissatisfied? Like, these are important, I think, issues, right? That providers, right? Are hygienists, doctors, are they leaving? And then number 6, and the final one is, and I'm going to talk a little bit about how you uncover all this in a second, but I would say
I was going to ask, how do you even approach that?
Yeah, I'll tell you, I have a secret sauce to that, actually. So number 6 is the patient outcomes, right? All of our businesses, David's business, Mike, your business, Paula, me, if we have bad client outcomes,
Mm-hmm.
right, that's a sign of really bad things, right? So as a seller, you got to look at those patient outcomes and say, are they double booking hygiene? Are there long wait times, right? Is there a salesy treatment conversation and coordinators, right? Do they not look at patient retention numbers, right? Like, these are the basics of what we have determined. These 6 are the ones that I think are the crucial data points for understanding whether a potential buyer is a good buyer, right? And so the question is, how do you figure this out?
Mm-hmm.
So, Paula, how do you think you figure this out? What would you do? I'm gonna put her on the spot.
Of all 6 things, right? All 6.
Yeah, I mean, just overall, like, how would you uncover this if you are helping a seller?
You're on mute, Paula. You're on mute, Paula.
Sorry, I had a noise in the background. Well, I mean, they can't talk to employees, unfortunately. If there's a time they could, that would be a real key way to find out. Reviews, looking at other offices and looking at the reviews would be another way. And then, I mean, looking at KPIs, looking at retention, active
That's right.
patient, the different KPIs of the schedule. But I mean, I think talking to employees
Boom.
would be the easy.
Well, that's right. That's exactly right. And so you hit it on the head. There's 2 things you said, and those 2 things are exactly the things that we tell them to do. One is pick up the phone and talk to other partners of that DSO. And I don't mean the 3 people that they gave you on a sheet that they said, call these 3 people.
Right?
Like, go on their website and look at all their partners and pick some random person in Omaha, right? And just be like, hey, how's it going?
Mm-hmm.
Can I talk to your office manager, right? Can I talk to your lead hygienist? And they will be more than happy because they will share, right? They will share this stuff with you, right? They will share this stuff with you. And then the second thing is the KPIs. For those that don't know what that means, they're key performance indicators. And that basically is a fancy way of saying, do your homework, right? Do your due diligence on the practice. You should vet them like they're vetting you, right? And then a lot of this stuff comes out.
I as you were going through all this, I couldn't agree more. Like, my client did that. They talked to one of the two that they provided. He probably didn't call random one. So I think that's key right there is random. Look at the list and randomly call. I love that. But this particular DSO did a summit, and they invited my client to a summit where there were existing owners and potential, like he was, owners, and they could round table and talk. And I think that showed some credibility that this DSO was not scared or nervous about their performance. So I thought that was good. I do
think reviews are good though, because whenever like all the practice I coach, even the practice I bought, you see things like, this place has gone downhill. They treat me like a number. They're always running behind. Like, it's not going to be a dead giveaway. But people are pretty vocal on reviews now. I mean, it depends on how long it's been owned, but it will rear its ugly head in your reviews if it's, but yeah.
Yeah. No,
go ahead, Michael. Sorry.
No, I think that's perfect. I wanted to like really put a crescendo here on this idea of performance, because one of the things that I see and Dave and Ollie, you guys see this way more, and you have clients that probably come back to you after the deal was inked, and they come back a year or two and bitch to you. I don't see that like you guys do, but this idea, two things, this idea of performance, because once you sell to them, they hold you to a performance standard that could affect your evaluation for a future payout. That matters. And number two, the actual idea of investing in this company. So what I don't think a lot of dentists think about is when you sell your business to a DSO, you are getting a check. But oftentimes that check, correct me if I'm wrong, is sometimes equal or even less than what a private practice dentist might buy it for from a bank loan, like we all know is the normal deal. But then there's like a holdback or a percentage. Like if I was selling my practice for $1 million and at close I got 600,000 and they're holding 400 back and putting that equity into the big company. And so, Ollie, you broke down these 6 things. David, you talked about a lot of these pitfalls in your little that segment that you gave us. But like, I think about like the confidence level of the parent company, their ability to resell it, the recap, I think they call it recapitalization, the recap. What is the confidence level that this company is actually going to recap and your shares are worth something, because you are buying into this DSO thinking that you're going to get a bigger kicker at some point. You guys see the deals way more. I know enough to be dangerous. What are those, David, what are those deal points, kind of percentages that you see a lot? Because to me, that's like a big thing for a seller. Do you want to go into bed with this company for 3 years to hopefully get a bigger earnout? It's like you're investing your money in Coca-Cola, or actually not Coca-Cola. It's a much smaller company. Coca-Cola is an easy decision. You're investing into a small company relative to Coca-Cola. 400 of your $1,000 of your equity is quote unquote being put into this small company. Are they going to perform? So David, do you see that a lot?
Yeah, I think this was an easier question to answer, several years ago, where I think it was rare, if ever, that we would have a client that would get equal to or lesser at closing than they would from a private sale. It was a home run. I mean, almost every single doctor that we had that sold to a DSO would get more at closing than they ever would from a private buyer. So they had significantly mitigated their risk just through that. Now, Does that mean that the doctor felt like it was, they didn't need the rest and it was sort of a bonus? For some, for others, they felt like they needed that money, and that's why they were selling to a DSO. So the stakes were higher. But I think, it's not so much that valuations were higher. I think it's more that of the enterprise value, more money was being paid at closing than it is now. And there's been, significant change as far as that's concerned. And so now, we still see a lot of doctors that are getting more at closing than they ever would from a private buyer, but there certainly are those that do not. And there's no question that DSOs, I mentioned earlier that they're dipping their toes in, and so are sellers. DSOs have really scaled back, and private equities really put the reins on in terms of mitigating their risk in these deals. And the biggest risk mitigator for them is less money at closing. Mm-hmm. And now you're seeing more like 50 to 60% of the enterprise value paid at closing, where back in the day, I mean, it was 80%. That was like the norm, right? That you'd get. So, I think that
so now there's more risk is what you're saying, meaning you're not getting as much at close as you were. And now you really got to decide private practice owner or DSO.
Less risk. Correct. Yeah, exactly. There's less risk for the DSO. There's more risk for the doctor these days. And that's by design by the DSOs, for them to be able to continue to dip their toes in and get back into action. They've had to change things. And now not only is there less money at closing, but there's different holdbacks that maybe different types of unique holdbacks, like for AR and other things that you wouldn't always see before, that you're seeing now. You're also seeing, if there is a recapitalization event or if there is an earnout, probably easier to discuss. If there is an earnout, it used to be home run every single time that earnout's paid in cash. Now you're often seeing earnouts are paid like half in stock, half in cash, right? So DSOs are definitely mitigating their risk through different methods. And I think doctors have to really try to thread the needle a bit now and navigate that. It doesn't mean that the great deals aren't out there, but doctors have to be a little more discretionary. Whereas back in the day, they could, throw their practice out and see what sticks. And most likely they're going to end up in a good spot, based on the type of money they're getting at closing. Doesn't mean the DSO would be a perfect fit for them from a personality and practice standpoint, but from an economic standpoint, it was harder to miss. But now, again, I kind of emphasize the value of a broker, but also not just broker, consultants like you guys. It's really important to have consultants on your team. Team is critical. Got to build a team. And that's going to help guide you through all these different layers to make sure that you're making the right decision if you're a doctor. So, speaking sort of like loud and clear, I think DSO deals are great for some, not as great for others. I think DSO deals today are harder to find that are optimal for a doctor than they were before, but they're still out there. We still have a lot of clients selling to DSOs, and a lot are successful, but you have to be careful and hire a great team. And I think, that comes from attorney standpoint, also comes from, consultants like you guys, and also brokers that are out there.
Yeah. Ollie, anything to add as we kind of put this thing to bed? I mean, it's difficult to have 4 people on a call to discuss a very robust topic. Thank you all for your contribution. Ollie, anything to really just take home on this topic? Hard to do in 40 minutes, but you guys have all done a great job.
Yeah, no, I mean, I think David summarized this last part about the valuations too, with regard to your question, Michael, really perfectly, which is, I think these groups are de-risking because they understand that, the heyday is gone, and they can't just, buy practices, consolidate them quickly, and then hope to recap and just be done with it. I think they see that they have to put a lot of work in, and sometimes the margins aren't there, as you were saying, Michael. And so they de-risk by giving less to the doctors, and they're taking then more of a risk. And I think the message that I would say is, there's zero doubt that there are some sellers out there where the DSOs and the groups are the only buyers that make sense, right? Because the practice is $2, $3, $4, $5, $6 million specialty group practice, and there's no one individual that can buy that office, right? And then there are practices where it's not necessarily the right practice for them to sell to a group, and I think that's a very personal decision that needs to be made, but and it has to be looked at with the help of lawyers and you guys as consultants and then financial advisors. And then a decision can be made, because if you're hoping that the sale of your practice to a DSO is going to fill your bucket, your retirement bucket, that is the wrong reason to do a deal, because a lot of times it can be negative. Now, there's a lot of things that we can do to help minimize taxes and things of that nature. But at the end of the day, it becomes, it's got to be a very kind of personal decision based on a lot of these other factors. So
I love that. I will say that if you're a struggling, quote unquote, struggling practice owner, I mean, not struggling, but like if you're just not loving ownership and you're in it, this is a legit option. You can get some help. And I think there are DSOs out there that are good at supporting you if you just need more help. I love being in partnership with Paula. She brings an element I don't have. I think we all need great partners, and I'm not an advocate for DSOs per se, but I will say that it's nice to have some support. And if your hygienist calls off for the day, maybe you can pull another one in from another location. Like there's a lot of upside to that, dealing with the KPIs and the business and the professional services. So why are you two smirking over there, Paula? I just
Paula has a question, Mike.
I can see your faces, and I hate it right now.
Listen, this is part of our relationship here. I get it.
Jeez, it's
Paula has a question she wants to ask, Mike.
Oh, I'm sorry, Paula. Go. Do you have a question?
Well, no, I was just gonna say, but then it's kind of like I'm in Arizona, so it's a little bit different in Arizona than a lot of the world or a lot of the US. And I just kind of noticed that shift. I don't deal directly with a lot of DSOs in my part of the consulting. But what I really noticed is the difference in the them wanting the doctor to stay on, and the compensation package and the length of time they have to, I mean, they really get them in there now, where I feel like before, back in the day, I mean, I'm originally from Indiana, and you had to have a doctor own, and I know a lot of states are still like that. So but now they're really having these sellers like stay on for quite some time, and there's a huge commitment. And I know just from my docs that retire, like when they're looking at these cash outs, they kind of want to get out. A lot of them are done. Some of them just don't want to own anymore, but some of them want to be done. I mean, is that just a feeling I have, or I mean, that has developed over time?
No, I think David would probably agree with me. I think that's exactly right. I think it all comes down to the de-risk conversation, right? As long as the seller is there, it's a much safer acquisition than if the seller leaves. Even if that's why they require them a lot of times to stay 5 years, and some of them just do 3 years now. But as soon as the owner leaves, the team leaves too, right? And Paula, from your days as a hygienist, like if your favorite doctor left, right, you would probably leave too at that point, because there's other opportunities. You know what I mean? Yeah. And so yeah, no, I think you're spot on.
Yeah. Well, it's interesting. So buyers, to kind of to put this to bed here, buyers, when you're looking private sale buyers, dentists, folks that are listening to this episode that are trying to get into a market, and it just so happens that you're competing against a DSO to purchase this practice, do not think that you are at a disadvantage just because they have more money or maybe PE backing or whatever. You have a solid chance. Appeal to the seller, appeal to their heart, take care of their patients, take care of their team, write the resume, reach out and call them and say, I will take care of your practice. That's what the seller wants to hear. And since they're not getting this big check that Ali and David said, they're not really getting anymore like they were 5 years
That's right.
ago, you have a solid chance. You have a solid chance.
Yeah, Mike, I remember this quote from President Obama after he left office, and it was really kind of funny. He was talking at this conference, and there were all these people who were talking about conspiracy theories and all this kind of stuff, like who's controlling the government and who's controlling corporations. And you know what he said? It was like, I'm paraphrasing, but basically what he said was, he's like, you shouldn't be scared of conspiracies and these large groups of people that don't, exist trying to control the world. That doesn't, there's nothing like that. He said, what's scary is when you realize when you're in power, like I was, that there's sometimes nobody actually in charge.
Wow.
And that the only thing you can hope for is to be provided notice that something's about to happen. And so when you think about it, that's kind of like the DSO world. There's some DSOs that, like you said, they think they're, everyone thinks they're so smart and they're backed by all this private equity, but sometimes there's nobody in charge. Like it's just kind of there and things are happening. And that's what's so scary if you're about to partner with one.
Yeah.
It's like, and I'm not necessarily, I don't hate them. I don't love them. I think they're good in some situations, bad in some situations. But man, when there's nobody in charge, that's really when it's scary.
Wow, that's a good one. That's good insight. Sometimes I don't think our private practices are in charge either. But
that's why they have you.
That's a different episode.
That's a different episode. Well, guys, Paula and David and Ali, thank you all for contributing. It's a great episode. It's a good topic. If anybody's curious or interested or nervous or whatever, listen to this one. It's a good one. So, guys, have a great.
Thank you for allowing me to speak. I appreciate it.
Yeah, thanks, Ali.
Happy holidays,
guys. Really appreciate it. Appreciate the opportunity. Thanks all. Good to see you, Ali. Good to see you, Paula. And Mike, thanks for everything.
See you guys. No, thanks, David. All right.
Thanks for listening. Let us know how you like the show. Rate us on Apple and Spotify. Subscribe and follow for more.